In September 2008, a 158-year-old institution, older than the telephone, the light bulb, and modern capitalism itself, collapsed in less than a week. Lehman Brothers wasn't a startup experiment. It had survived civil wars, world wars, depressions, and revolutions. And yet, one Monday morning, it simply ceased to exist. No bailout, no rescue, just silence. What followed wasn't just a bank failure. It was the moment the global financial system came closer to collapse than at any point since the Great Depression. In this video, we'll explore how a centuries-old investment bank became the symbol of modern financial failure. We'll trace how the system was built, how hidden risks quietly piled up, and why a single collapse triggered a worldwide economic shock. More importantly, we'll look at what the 2008 crisis reveals about trust, leverage, and why financial systems tend to look strongest right before they break. Let's start with Lehman Brothers. Lehman Brothers was founded in 1850, originally as a dry goods business in Alabama. Over time, it evolved into one of Wall Street's most powerful investment banks. By the early 2000s, Lehman was deeply embedded in the global financial system, trading securities, underwriting debt, and advising governments and corporations. It wasn't reckless by reputation. It wasn't fringe. It was considered systemically important, which makes what happened next even more unsettling. Here's where it gets interesting. The housing boom. In the early 2000s, the United States experienced one of the largest housing booms in history. Interest rates were low. Credit was easy. Home prices kept rising. Banks discovered they could bundle thousands of home loans together and sell them as mortgage-backed securities. These were then sliced into layers, rated, and sold to investors around the world. The logic seemed sound. If one homeowner defaulted, the rest would cover the loss. Housing, after all, had never fallen nationwide before. This belief became the foundation of the modern financial system. But beneath the surface, the quality was deteriorating. As demand for mortgages increased, standards quietly declined. Subprime loans, mortgages issued to borrowers with weak credit, became common. Adjustable rates replaced fixed ones. Documentation became optional. According to data later cited by the Financial Crisis Inquiry Commission, a growing percentage of loans were issued to borrowers who had little ability to repay them. But the system didn't slow down. It accelerated. Why? Because risk wasn't staying in one place. It was being spread everywhere. The illusion of safety. Rating agencies, using flawed models, often labeled these mortgage securities as AAA, the same rating as U.S. government debt. To investors, this looked safe. To banks, it looked profitable. Lehman Brothers leaned heavily into this market. By 2007, Lehman held over $600 billion in assets, supported by just a thin layer of equity. Its leverage ratio exceeded 30-to-1. In simple terms, this meant a small decline in asset values could wipe out the entire firm. Lehman was walking a financial tightrope, with no net underneath. Then the housing market turned. In 2006, housing prices began to flatten. In 2007, they started falling. Defaults rose. Mortgage securities lost value. Confidence began to crack. Other investment banks quietly reduced exposure. Lehman didn't. Instead, it doubled down, believing the market would recover. This wasn't blind optimism. It was structural pressure. If Lehman sold its assets, prices would fall further, exposing losses immediately. If it held on, it hoped time would fix the problem. This is what economists call a liquidity trap, and Lehman was caught inside it. Here's the twist. It wasn't just about losses. Lehman didn't collapse because it ran out of assets. It collapsed because it ran out of trust. In modern finance, banks don't fail when they're insolvent. They fail when no one is willing to lend to them overnight. By September 2008, counterparties began refusing to do business with Lehman. Short-term funding vanished. The bank was alive on paper, but dead in the real world. The weekend that changed everything. Over the weekend of September 13, 2008, U.S. officials scrambled to find a buyer for Lehman. Barclays considered a takeover. Bank of America walked away. But unlike Bear Stearns months earlier, the U.S. government chose not to intervene. On September 15, 2008, Lehman Brothers filed for bankruptcy. It was the largest bankruptcy in U.S. history, and it sent shockwaves across the globe. The domino effect: markets didn't react calmly. They froze. Money market funds broke the buck. Interbank lending collapsed. Stock markets plunged. Within days, AIG required a massive government bailout. Global trade slowed dramatically. Millions lost jobs. According to World Bank estimates, global GDP contracted sharply in 2009, marking the worst downturn since World War II. Lehman wasn't the disease. It was the symptom. Why the system failed? The crisis exposed several structural weaknesses: excessive leverage, blind faith in models, misaligned incentives, over-reliance on short-term funding, and a belief that markets could regulate themselves. As explained by economists and finance educators on channels like Economics Explained and Cold Fusion, complexity had created fragility. The system looked sophisticated, but behaved like a house of cards. What made Lehman different? Other banks were just as exposed. But Lehman lacked two things: political backing and time. Its collapse became the moment policymakers realized how interconnected the system truly was. Ironically, Lehman's failure is what led to massive bailouts afterward, because the alternative had proven unthinkable. The fall of Lehman Brothers wasn't caused by greed alone. It was caused by a collective belief that risk had been eliminated, when it had only been hidden. For years, the system rewarded short-term gains and ignored long-term stability. Complexity replaced caution. Confidence replaced humility. And when trust disappeared, everything else followed. The 2008 crisis reminds us of something deeply uncomfortable. Financial systems don't fail slowly. They fail suddenly, after long periods of apparent success. In the end, every financial revolution begins with innovation, and collapses when that innovation outpaces responsibility. If you found this story insightful, consider subscribing for more calm, cinematic explorations into how money, power, and economic systems shape our world. This is Cold Insight. Thanks for listening.